Allow me to greet you this day, and I'm about to record example number 2 on the topic of intangible assets, and it is under the umbrella topic called property, plant and equipment. Now, this part of the PPE is the side of the PPE where we deal with the assets that are intangible. That means assets that we cannot touch, assets that are without monetary value, and assets that are invisible. But they are distinguishable, and that is the definition of an intangible asset. Now it says in this question, we are required to show the note to the financial statements of Drink Ltd for the intangible assets to reconcile the opening and the closing net carrying amounts of the Sift Glinder brand only for the financial year that ended 30th of June 2010. So now we are only focusing on the Sift Glinder brand. Although this company does have other intangible assets, but we will only be given information and doing this note only for one intangible asset called a Sift Glinder. Now, reading the information, it says the brand was purchased on the 31st of August 2008 for 480,000 rands cash, and the brand was ready for use immediately. So now the cost of the brand, in this case, it is 480,000 rands. That is the cost of the brand. And it was available for use on the date of the purchase. That means when we are calculating what is called amortization, remember amortization is not a new thing. It is the same as what is usually called depreciation. But the depreciation of the intangible assets, we don't call it depreciation, we call it amortization. So now that means when we start calculating our amortization, we are going to start at the date the asset was ready for use, which is 31st of August in the year 2008. That means it's at the end of the year. We start in September, October, November, December. We don't know when is the end of the accounting period, but we are provided that we must do the note by the end of June. So that means the accounting period must be at the end of June every year. So now that means we have to calculate the amortization from September, October, November, December, January, February, March, April, May, June. So that will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That means in the first year, we are going to calculate amortization for 10 months, in other words. So this will be for the first 10 months up until the 30th of June, 30th of the 6th month in the year 2009. Because from September up until December, it is still the year 2008. Then from January up until June, this is in the year 2009. So now that means the amortization for the first year will only be for a period of 10 months in the 2009 accounting period. Now we continue on that same note. It says that on the same date, meaning on the date the asset was ready for use, 31st of August 2008, the Sift Glinder brand was estimated to have the following useful life. And we are told that the useful life of this brand, it is estimated to be 10 years at the date it was ready for use, meaning on the 31st of August, meaning on the 1st of September, in other words. Then after, we are told that the residual value of this brand, it is 0. Why the residual value is 0? Because after the brand contract has expired, or after we have used this brand for a period of 10 years, we will no longer be allowed to produce any product under this brand. That means immediately at the end of the useful life, the brand does not have a residual value as an amount. So the residual value is always 0 for an intangible asset. On the 30th of June, meaning now 10 months down the line, that means from the 1st of September, meaning end of August, up until 30th of June, that is where we are. We know that the period here, it is a period of 10 months. At the end of June 2009, the Sift Glinder brand was estimated to have a recoverable amount of how much? Recoverable amount of 400,000 rands. Now, whenever you are given a recoverable amount, you must calculate the carrying amount at the same date so that you can say recoverable amount, vice versa, the carrying amount, to test if is there any impairment loss at that specific point in time. Now let me do this because I do have the cost of this brand, and I do have the useful life of this brand, and I do have the residual value of this brand as 0, so I can calculate the amortization from the date the brand was available up to the end of the accounting period, which is the date where I am given the recoverable amount. So now let me calculate that, which is called amortization. So now let me calculate my amortization. Amortization will be the cost of the asset of 480,000 rands minus residual value of 0 divided by 10 years. This will give me amortization for the full year. 480,000 rands divided by 10, it gives me 48,000. So now this is 48,000 amortization per annum for the full year, but I only need it for 10 months from the 1st of September up until the 30th of June 2009. So I multiply this by 10 over 12 in order for me to get amortization only for a period of 10 months in the accounting period of 2009. So now I can say that my amortization is an amount of 40,000 rands. So now this is amortization for the period of 10 months. So now I can say carrying amount is equal to cost minus amortization, meaning cost minus accumulated depreciation, meaning in this case minus accumulated amortization. And our depreciation or amortization, it is 40,000 rands. 480,000 rands minus 40,000 rands, I get 440,000 rands. So now we look at the carrying amount, we compare the carrying amount with the recoverable amount, and we can see that the recoverable amount is less than the carrying amount. Then the difference will be what we call impairment loss, minus 400,000 rands. So now that means the 40,000 rands will be an impairment loss. That means in this scenario now we have impairment loss. We have impairment loss which is equal to 40,000 rands. Where this 40,000 rands coming from, it is 440,000 rands, which is the carrying amount, vice versa the recoverable amount of 400,000 rands. This gives us the amount of 40,000 rands as an impairment loss. So now we are provided with that information so far. Continue on that same note. It says at the end of June 2010, meaning a year later now from the previous year, the Sift Glinder was estimated to have a longer useful life than was initially expected. And it was estimated that from the 1st of July, this is very important, they are taking now the decision, meaning the directors most of the times, or in other words, the change in estimate is taking place on the first day of the accounting period. That means one day after June, we can say that on the 1st of July, the brand would have had a remaining useful life of how many years? Of 10 years. Now, this is very important to highlight because if the date here was 30 of June 2010, it will still be treated as the same. Because if the change in estimate takes place at the end of the year, we always assume that it must have been the same case beginning of the year. So now that is why even if this estimate had taken place at the end of June 2010, meaning the end of the accounting period, we assume that things have been in that situation at the beginning of the year. So now it will be still treated as the remaining 10 years of the useful life. And immediately, if they say remaining useful life, then you have nothing to worry in terms of calculating the number of years that are remaining for the change in estimate. Now, remember, the useful life was 10 years, and now they are telling us that the remaining is 10 years, and they are saying it's longer. Is 10 years longer than 10 years? They say it was estimated that this asset will have a longer useful life than expected. Now the question is, 10 years really longer than 10 years? The answer, 10 years is not longer than 10 years, but in this case 10 years is longer than 10 years. Now what does that mean? Remember, this asset was available for use, and on that same date the useful life was 10 years, meaning from the 1st of August. But you can see now is the 1st of July 2009, and the remaining useful life is still 10 years, even after 10 months are gone. Now we can see that because 10 months is gone, that means it should be 10 years minus 10 months, then that should be the remaining useful life. But now, even after the 10 months is gone, we can say that the useful life of this asset still remain at 10 years. So now that is why they say it is longer, yet it is still the same 10 years. Now, if you are given the remaining useful life, I said to you that you don't have to do any calculations in terms of the number of years for the change in estimate. What do I mean by that is because they could have removed this remaining and say total useful life. If this was total useful life, that will mean 10 years plus the 10 months that are over. 10 years plus 10 months. So now it will be 10 years plus 10 months. That means the total useful life now of this intangible asset on the 1st of July, it is 10 years plus 10 months. Therefore now, if it's 10 years plus 10 months total estimated new useful life, therefore now we need to say how many years are already gone. We say no, it's not number of years. 10 months are already gone. Then we say now out of this 10 years plus 10 months, we say minus 10 months because 10 months is already gone. Then how much is remaining? The remaining one is 10. So now it is very important to master when they say it's remaining and when they say total useful life. I want to bring your attention to the previous question that I have recorded already in terms of this explanation. In the previous question or previous example, they said they estimated that the brand will only have a total useful life. Take note, not the remaining, a total useful life, meaning the total useful life. And what are we looking for now? We are looking for the remaining useful life, considering the fact that the asset was available for use on the 1st of July 2011. Now from the 1st of July 2011 up until December, 6 months is gone. So now we need to say out of this total useful life, which is a new estimate, 6 months is gone, meaning from July up until December 2011, 6 months is gone. So now we say out of this 8 years, we need to minus 6 months. Remember, these are years. So now we need to convert the month into years. 6 over 12, it will give us 0.5. That means 8 years minus 0.5 years will give us 7.5 remaining useful life. So now meaning also in this question, they could have given us 7.5 as the remaining, not total. If they said the remaining useful life and they say 7.5, then we wouldn't have to worry about calculating the remaining because they have already given us the remaining. But in this scenario, they gave us the total of 8 years. So we needed to minus the other years from the date the asset was available for use and ready for use up to the date of the change in estimate. And I want to highlight one other thing again when it comes to this question in comparison with the one that I'm doing. In this one, the change in estimate took place at the end of the year, meaning end of December. And we say, no, if it's end of December, we must bring it to the beginning of the year, 1st of January 2012. So now this is from this is from July 2011 11 up until, in other words, 31st of December 2011, which is the same as the 1st of January 2012, because closing balance is the same as the opening balance. So now, in this case, the date was at the end of the year, and whenever the date is at the end of the year, we must bring it to the beginning of the year, because we assume that this change in estimate must have been the beginning of the year, not necessarily at the end of the year. So I just wanted to link these two questions because there are small differences that need much clarity so that you can go and get your 100% in this test of the intangible assets. Therefore, now we continue on that same note. We are very clear that we are given the remaining useful life. There's nothing to worry in terms of the calculations. And it says on the 30th of June 2010, the recoverable amount of the brand was estimated at 370,000. Now, this will be another opportunity where we need to test for the impairment, where now we must calculate the carrying amount at this date, meaning end of June 2010. Therefore, now at this point in time, allow me to go and respond to the requirement where I am required to do the note. And take note, I've already done the note for you. All I need just to say Sift Glinder brand. Therefore, now what do we start with? We start with the net carrying amount. We start with the net carrying amount. Net carrying amount is at the end of the previous year, which is on the 30th of June in the year 20. This should be 2008 and 2009. I think this question paper is those 2 years. Yes, we do 2009 or 2009 and 2010. Okay, 2009 and 2010. So we do 2009 and 2010. So this is the previous year, meaning the year before the year of the requirement, meaning the year at the first recoverable amount that is provided for you. So now we go there and we say, first thing that you must do, the net carrying amount is the recoverable amount at that date, 400,000 rands. We are provided with the recoverable amount 30 June 2009. How much? It is 400,000 rands. Make sure you start with that and you draw a line below that. You draw a line. Your net carrying amount is always your recoverable amount at that date. Remember, this is net carrying amount 30 June 2009, and this is the recoverable amount on 30 June 2009. Is always that case. Master that. Very, very easy strategy. Then after now, we record the cost price of the asset, which we call that gross carrying amount. Gross carrying amount. This is the cost of the asset. We use the language gross and net only in the intangible assets. In this case, we had a gross carrying amount of 480,000 rands. And we need to calculate what is called amortization or accumulated amortization, which is usually called amortization or accumulated depreciation. Amortization. Accumulated amortization. How much is our amortization? It is 40,000 rands. Remember, our amortization is calculated from the date the asset was ready for use, which is 31st of August up until the date of the recoverable amount. Our recoverable amount is at 30th of June 2009. So we calculated that this should be a period of 10 months, September, October, November, December, January, February, March, April, May, June, meaning now June 2009 is 10 months. And we said this divide by 10 being the useful life. Remember, it will give us 48,000 rands for the full year. Amortization for the year, multiply this by 10 over 12, it gave us amortization, meaning depreciation of 40,000 rands. So this is where this 40,000 rands is coming from. Now step number 2, what do we do? Now immediately after the cost and amortization up to the date the asset was given recoverable amount, what do we do now? We just say, to make things easy, 480,000 rands minus 40,000 rands we can say that this still gives us 440,000 rands. It does not give us that 400,000 rands. How much do we need to deduct? We need to say minus 400,000 rands, and we can say that there is a 40,000, which we have already calculated the 40,000 also to be an impairment loss. So now this will be impairment loss or accumulated impairment loss. So this will be our impairment loss, which we calculated by saying a recoverable amount at the end of June 2009, it is 400,000 rands, and said our carrying amount at this date, it is 440,000 rands. And the 440,000 rands, we know that it was 480,000 rands of the cost of this asset minus amortization of 40,000 rands, meaning minus depreciation, and this gave us 440,000 rands as the carrying amount, meaning the value of the asset at the date in our books. We are provided the recoverable amount. So now we said that the difference is 40,000 rands, and this difference is what we call impairment loss. Why do we call this impairment loss? Because the value of the asset in our books is less than the value of the other similar assets in the market. So now we need to decrease the value of our asset by 40,000 rands. So now the minute we do that, that becomes impairment loss. In case of the inventory, this is normally called inventory write down or inventory loss, but it's a different scenario. So just something similar to this one. Now we continue on the same note. Then now we are done with this one. Then we go to the second stage. Second stage is to remember this is at the end of June 2009. Don't forget that. So we are done with information regarding up to end of June 2009. Now we need to look for the information for the year 2010. Information for the year 2010. They say at the end of June 2010, take note of that. At the end of June 2010, the Sift Glinder was estimated to have a longer useful life, and now it was than it was initially expected, and it was estimated that from the 1st of July 2009. And take note, the decision is taking place when? At the end of the year. Again, it's similar to the previous one, because they say at the end, meaning the decision is taken on the 30th of June, but they are telling you that is on the 1st of July. Now the dates are not matching end of June, but because we have to bring the date to the beginning of the year. So this will be bringing the end of the year decision to the beginning of the year. And they have done this for us. It's very easy and very simple. Now that means we are coming to the year 2010 now, where we are told that the useful life of this asset is remaining 10 years. So now we need to calculate the amortization based on the new estimate. First of all, how much is the value of the asset at this date? How much is the value of this asset 1st of July? The value of this asset 1st of July is the carrying amount. How much is the carrying amount of this asset? The carrying amount of this asset now, after the impairment loss, take note, the carrying amount after the impairment loss, it is 400,000 rands. So now what do? We say 400,000 rands, which is the recoverable amount, then becomes the cost of the asset based on the new estimate. Now this is the new estimate. In other words, if there's a change in the estimate, what we do, we take the carrying amount, which is normally equal to the recoverable amount, to be equal to the cost of the asset. Meaning we must use the carrying amount, which is normally equal to the recoverable amount, as the cost of the asset to calculate amortization for the remaining useful life. This is what this simply means. That means now we must say 400,000 rands divide by 10, 400,000 rands divide by 10, then it gives us amortization for the current year now, which is the year 2010, for an amount of 40,000 rands. So now what do? We are record our amortization. we record our amortization for the current year. Amortization for the current year, it is 40,000 rands. Remember, amortization of the previous year plus amortization of the current year becomes accumulated amortization at the end of the current year. I'll deal with that as soon as we can. Then now we go to the end. At the end, what do? We have net carrying amount now at the end of the required period. Net carrying amount, our net carrying amount at the end of June in the year 2010. What is the net carrying amount? Net carrying amount is the recoverable amount at this date. Remember, net carrying amount is equal to recoverable amount at this date. The question is, do we have a recoverable amount at this date? Yes, we do have a recoverable amount. Our recoverable amount at this date, which is at the end of June, it is provided to be 370,000 rands. 370,000 rands. Then after we come, don't forget, the cost must be there, amortization and impairment if there is still necessity for the impairment. Then after we say gross carrying amount. And again, we use the term net carrying amount and gross carrying amount only when it comes to the intangible assets, which is the cost of the asset. The cost of the asset does not change, it is still 480,000 rands. Then we need to subtract accumulated amortization. Accumulated amortization will be an amount of 80,000 rands. Where is the 80,000 rands coming from? Remember, depreciation of the previous year plus depreciation of the current year will give us total accumulated depreciation at the end of the year. That means amortization of the previous year plus amortization of the current year will give us total amortization at the end of the current year. So this is the same as your normal tangible asset. Therefore, now what do we do from this stage? We just have to draw a line here, because we know that there must be an amount here and we don't know what this amount will be. What do? We say now 480,000 rands minus 80,000 rands. How much do we get? We get 400,000 rands. And if we say 400,000 rands, it is not the same as the amount of 370,000 rands. So there is still some figures to be deducted. So now let us say minus 370,000 rands. And we can see that the amount that need to be deducted from that 400,000 rands, it is an amount of 30,000 rands. That means now our accumulated impairment loss has decreased. Accumulated impairment loss. Why am I saying that? Because our impairment loss of the previous year, it was calculated as 40,000 rands. This was 40,000 rands of the impairment loss. But we can see that the amount of the impairment loss now is no longer 40,000 rands, but it is 30,000 rands. That means there must have been a decrease from our impairment loss by how much? By 10,000 rands. What will be that 10,000 rands? It will be prior year impairment loss reversal. That means the impairment loss of last year must have been reversed by how much? By 10,000, so that it can become 30,000 rands. Let us test that if is that true. Remember, for us to reverse the impairment, that means the carrying amount of the asset must be greater than the recoverable amount of the asset at that date. That means it is very likely that at the end of June, not greater. That means at the end of June, the carrying amount of this asset must have been less than the recoverable amount. That means the carrying amount of this intangible asset must have been less than the recoverable amount at the end of June, where the recoverable amount was 370,000 rands. It means the carrying amount must have been 360,000 rands. This is what this information is telling me, because If my carrying amount is 360,000 rands and my recoverable amount is 370,000 rands, that means my asset will not be impaired, meaning there will not be impairment loss, but it must increase in value. Therefore, now if there is no impairment, that means we must reverse the impairment of the previous year in the case where the carrying amount was more than the recoverable amount. So now we can see that this 10,000 indicate that there must have been a carrying amount that is less than the recoverable amount. Let us check if that is true in this scenario. If do our numbers match what I will explain now or the reality. Now let us go there. We know that first of all that our recoverable amount at the end of June, it is 370,000 rands. Remember, we are busy with the current year where there is a change in estimate. And I said to you, when there is a change in estimate and we're calculating our amortization, we say 400,000 rands divided by 10, if you remember. And we said now why? Because we must take the carrying amount at the date of the change in estimate to be the cost of the asset. So we calculated the current amortization based on the carrying amount of the previous year, meaning beginning of the current year, which is 400,000 rands. That means now when we are calculating our carrying amount, we don't calculate carrying amount based on the old cost, but we calculate our carrying amount based on the carrying amount of the previous year, meaning based on the recoverable amount of the previous year, meaning in this case the net carrying amount. That is what we do now. So now if that is the case, that means our carrying amount will be the cost according to the new estimate, of which the cost in the new estimate of the asset, it is the value of the asset at that date, which is 400,000 rands, because this is the value of this asset. We reduced, remember, we reduced our asset from its value to 400,000 rands, so that it can be equal to the recoverable amount. So we say 400,000 rands minus 80,000 rands. 400,000 rands minus 80,000, or not 80,000 rands, 400,000 rands minus 40,000 rands. Now, why am I deducting 40,000 rands? Because of the change in estimate, we had a new amortization of how much? Of 40,000 rands. So now we say the carrying amount minus the amortization of the change in estimate. Amortization of the change in estimate, meaning amortization after the change in estimate. So now we don't say amortization, we don't say cost, which is the normal cost, but we use the carrying amount. We minus the amortization of the change in estimate. So hence we say 400,000 rands minus 40,000 rands. So now our carrying amount becomes 360,000 rands, which is exactly the same number. We can say that our carrying amount, it is less than the recoverable amount. And if that is the case, we will get to an amount of 10,000 rands, which is reversal of the impairment. Meaning now the impairment loss must be reversed by 10,000. Remember, impairment loss is reducing the value of the assets. Therefore, now when we do the reversal, that impairment loss reversal must be captured as positive, so that we can be able to say impairment loss of the previous year was minus 40,000 rands. It was minus 40,000 rands plus impairment loss reversal of 10,000 rands. Then this becomes minus 30,000 rands at the end of the accounting period. So this is quite important to be mindful of. Very, very, very important. More especially how you calculate. This amount. How you get to this amount. But immediately, if you start with this cost and the accumulated amortization, it is easy for you to get here. And immediately, the minute you see this figure, which is this 30,000, is less than the previous impairment loss, then you know that there must have been a reversal, which is the difference between the 40,000 rands and the 30,000 rands. That means the reversal then becomes an amount of 10,000 rands. So now this is how you can work yourself around this question. Not so much difficult. If you have any further questions, please highlight me, then I will respond to you and give you even more clarity on that. With that, guys, you've been a wonderful audience. You listened attentively, and I hope you grabbed something out of this question. Thank you very much. God be with you.